Upstart grew originations 50% and their share count actually went down. That's the bear case on this stock quietly getting dismantled. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Upstart Holdings gets graded and traded. So on the headline, revenue came in just under 5% ahead of estimates at $365 million, and that's up 42% year over year, which is a real re-acceleration for this business. On EPS, they beat by about 5.5%, coming in at 16 cents a share versus 5 cents a year ago. That's a return to GAAP profitability, and net income was up 195% year over year. So on the beat itself, this earns a C. Both lines were beats, but they're modest single-digit beats. The story here is the underlying growth, not the surprise size against estimates. And on consistency, this earns an A. Upstart has been putting up reliable beats quarter after quarter, and this print keeps that streak going cleanly. Let's talk about the positives from the report. Originations hit $4.2 billion on over 558,000 loans, and both numbers were up 50% year over year. That's the clearest sign yet that borrower demand and lending partner capital are moving together at scale again. They returned to GAAP profitability with net income of $16.5 million, up 195% from $5.6 million a year ago. Diluted EPS jumped from 5 cents to 16 cents. And here's the number that really jumped out at me. Unsecured contribution margin expanded 600 basis points sequentially to 62%. That means the core lending book is getting more profitable per dollar of revenue, even as it's scaling up fast. The secured products side, that's auto and home lending, went from a negative 176% contribution margin a year ago to negative 35% this quarter. Still a drag, but a much smaller one on a real path toward break-even. And this is the one that matters for shareholders. Share count actually went down slightly, from 98 million to 97.3 million. They grew originations 50% without diluting anyone. That kills one of the biggest bear arguments on this stock. So on profitability, this earns an A-. Return to GAAP net income, 600 basis points of margin expansion in the core book, and growth funded without new equity. That's about as clean as a profitability picture gets for a lender re-accelerating. Now let's talk about the negatives from the report. Overall contribution margin actually compressed 300 basis points year over year, from 58% down to 55%. So even with the unsecured book improving, the blended picture went the wrong way. The reason is sales and marketing spend was up 57% year over year to $114.5 million, and that outpaced the 45% fee revenue growth. So the growth is real, but it's being bought, and that trade-off is what I'll be watching over the next few quarters. Management maintained the full year 2026 guidance at about $1.4 billion in revenue and $294 million in adjusted EBITDA. They didn't raise it after a strong second quarter, and that's a signal the back half embeds more caution than this print alone suggests. Operating cash flow was negative $270 million in the first half, worse than the negative $134 million a year ago. That's the capital intensity of funding loans on balance sheet before selling them. And wheel traders need to understand that before assuming this beat means free cash generation. And fair value adjustments swung to a bigger loss of $27.8 million versus $21.3 million a year ago, including a realized loss on loan sales. Credit marks are still choppy even as originations accelerate. So on guidance, this lands at a C. They held the range flat when a strong second quarter arguably called for a raise, and that maintained guide is the single most important forward signal in the release. And on red flags, I'm at a C+. Nothing broken here, but the $270 million operating cash outflow and the 57% jump in sales and marketing spend are real trade-offs I can't dismiss. Putting it all together, Upstart delivered a clean re-acceleration quarter, 50% origination growth, return to GAAP profitability, and unit economics improving in the core book. The bear case that this business needs dilution to grow got quietly dismantled when share count actually went down. But management maintained the full-year guide instead of raising it. And that's the tell that the back half embeds more caution than the Q2 numbers alone suggest. Weighing the real operational strength against the maintained guidance and the capital intensity, this print earns a B- from me. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. The story here got a lot more interesting for me, with originations re-accelerating to 50% growth and the company back to real GAAP profits. That's the kind of print that pulls me off the sidelines. But management only maintained the full-year outlook. They didn't raise it. So I'm not going to chase shares the day after earnings when everything is running hot. My plan is to wait 2 or 3 sessions for the earnings day volatility to bleed out and then sell cash secured puts, while implied volatility is still elevated, but not at that peak that gets crushed fastest. So for me, I'd sell puts after the volatility settles down a bit. When I'm picking my floor strike, I'm looking for a level that still works even if the back half of the year just meets guidance instead of beating it. That's where the core unsecured business economics still hold together for me. For my ceiling strike, I want a price where I'd genuinely be okay taking the shares. Not just a strike that pays well, but one I could actually own. And I keep reminding myself, this is a lender with $270 million in negative operating cash flow in the first half. Assignment on a credit cycle name is a very different animal than assignment on a software stock. So I anchor my strikes to the fact that this is lender risk. This print pretty much confirmed why I own the shares in the first place. 62% contribution margin on the unsecured business, back to real GAAP profits, and the share count is actually shrinking. That's the trifecta. With implied volatility jacked up after earnings, I'd sell covered calls against a portion of my position to pull some income out of that elevated premium. But I keep enough shares uncovered so that if the secured products keep improving and the market starts giving this stock a higher multiple over the next couple of quarters, I still ride that move. So for me, I hold and sell some calls against part of it. If my covered calls ended up near the money after this print, I'm rolling them up and out. The fundamentals just got stronger, so I want to give the position more breathing room and grab more time premium in the process. Management maintained the full-year outlook instead of raising it, and that naturally caps how far shares can run in the short term, so I don't feel like I'm giving up a moonshot by having calls on. The one thing I wouldn't do is panic close my calls at a loss just because the stock popped. With guidance only maintained, those calls likely still have real value, and I want to manage them, not blow them up. So my move is to roll up and out to give the trade some room. This print made my long-dated thesis a lot stronger. Return to GAAP profits and a 600 percentage point sequential jump in unsecured contribution margin tells me the runway just got extended. The other piece I love is the secured products drag, shrinking from negative 176% to negative 35% year over year. That headwind is fading fast. If my leaps are already deep in the money, I'd think about rolling up and out to a higher strike out into 2027. That lets me pull some gains off the table while keeping my long-term exposure intact. So I hold, and I roll the deep winners up and out. If my original reason for owning this was that the AI underwriting model works through a full credit cycle and scales without diluting shareholders, both of those got confirmed on this print. So averaging down is defensible for me here. But instead of just buying more shares outright, I'd rather sell cash-secured puts. That way I take advantage of the elevated implied volatility and give myself a lower effective cost basis if I get assigned. Now, if my thesis was that any earnings beat would trigger a guidance raise, that part got partially invalidated because management only maintained the full year outlook. I have to reset those expectations before I add another dollar. So for me, I add through puts, not through shares. Bottom line, this print earns a B- from me. The core lending model is working, growth is real, and it's happening without dilution. But the maintained full year guide keeps this from being a fully upgraded name. Thanks for watching, and I'll see you on the next one.